www.investing's.com Derivative contracts. Derivative contracts involve trading underlying assets. Derivative contracts. Derivative contracts involve trading underlying assets. If you have ever dabbled in the world of finance and investments, you may have come across the term derivative contracts. While it may sound complex and intimidating, derivative contracts are actually quite common and play a significant role in financial markets. In simple terms, derivative contracts involve trading underlying assets. So, what exactly are derivative contracts? Essentially, they are financial agreements that derive their value from an underlying asset or securities. These underlying assets can range from commodities like gold or oil, currencies, stocks, bonds, interest rates, or even market indices. The value of the derivative contract is directly tied to the value of the underlying asset. Derivative contracts serve various purposes in the financial world. Some common types include options, futures, swaps, and forwards. Let's take a closer look at each of these derivative contracts. Options. Options provide the buyer with the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specific time frame. There are two types of options: call options, which give the holder the right to buy the asset, and put options, which give the holder the right to sell the asset. Futures. Futures contracts require both parties involved to buy or sell an asset at a predetermined price and date in the future. These contracts are standardized and traded on exchanges. Futures contracts are commonly used by producers and consumers of commodities to lock in prices and hedge against price fluctuations. Swaps. Swaps involve the exchange of cash flows or liabilities between two parties. They are typically used to manage interest rate risk, currency risk, or credit risk. For example, a currency swap allows two parties to exchange cash flows in different currencies based on a predetermined exchange rate. Forwards. Forwards are similar to futures contracts, but they are not standardized or traded on exchanges. The terms of a forward contract can be customized to meet the specific needs of the parties involved. They are commonly used for hedging purposes or to lock in future prices. Derivative contracts are widely used by individuals, institutional investors, and businesses for various reasons. They can be used to hedge against price fluctuations, speculate on market movements, manage risk exposure, or gain exposure to certain assets without actually owning them. However, it's important to note that derivative contracts come with inherent risks. The value of these contracts can be highly volatile and fluctuate based on changes in the underlying asset's price or market conditions. Therefore, it is crucial to have a thorough understanding of the underlying asset, the terms of the contract, and the associated risks before engaging in derivative trading. In conclusion, derivative contracts are an integral part of financial markets and offer opportunities for investors and businesses to manage risk, speculate, and gain exposure to various assets. While they can be complex, with the right knowledge and understanding, derivative contracts can be a valuable tool in navigating the ever-changing landscape of the financial world. As with any investment or trading activity, it's always advisable to seek professional advice and conduct thorough research before engaging in derivative trading. www.investing's.com Derivative contracts. Derivative contracts involve trading underlying assets. Thanks for watching.